All right. Good morning, everybody. We have PCE today. Hong Kong is up the most, was up the most. Europe did really good. Remember that Europe had a rate decision earlier this week, right? Now they're up 1.5%. Japan, 0.5%. The Russell in the green, the only one in the green right now, although the others are trying to work their way back up. NASDAQ down the most. There was some earnings that on the semiconductor front that didn't turn out so good. Kind of changed the landscape a little bit. So looking at Market Watch, this is the site that only really likes to put on the economic agenda, the biggest ones for the day. You can see we've got a lot of things today on the list, right? This is going to be that kind of day today, but a lot of them are right up front. So when we get through to the afternoon, we should have a fairly decent afternoon. So here on Finance Juice, they talk a little bit about what's going on in Europe that gave it the lift. It's worth taking a look at. We're still in blackout mode for the US, and that gives Yellen center stage. She can talk without having to share the spotlight, and she likes that. She's already been out chipping teeth. Remember that we got QRA at the end of the month, so we want to pay particular attention to what Yellen has to say. It's going to be a big deal. And we're getting closer to the FOMC. It's not unknown about January meeting, right? There's no conflict here. We're all fairly certain that the Fed is going to hold in this January meeting. So that's not the unknown. There's so many more unknowns right now than this that are much more important. So that's not the issue. The issue is, what are they going to say in this January meeting about March? And when are they going to hint about the cuts? Remember that the dot plots was something that they were talking about right after the last meeting. And then everybody shifted away from talking about them. And now they're talking about these projections instead of the dot plots. The Fed had started to put in a cut on general purpose, right? GP, just because, to kind of normalize things a little bit. They weren't going to wait until something broke to start cutting. But we're getting more and more negative news to the point where they may end up cutting because we've got negative news instead of just because. So we're still looking for this guidance, and this is going to be one of the things that we are going to be listening for in that January meeting is what are they projecting going forward? When might they do a cut? And the market doesn't know what to do with this, right? They wound it up and then they unwound it and pulled it all forward. All these cuts, they started pulling them forward starting back in November, December. And then they had to kind of walk that back a little bit. And so you can see just so much indecision here. We're going to look for this to be cleaned up, right? But first, we got to get through QRA with Yellen. I mentioned sharing the Thinkorswim and TradingView levels yesterday, that I would share them every day in the chat and that you can download them. And if you don't have the indicator, just go to create, put the code in there, give it a name. And once you do that, everything on the OEC watch list that you go to will have those options levels. The GEX, the standard deviations, call wall, GEX flip, they'll all be there, right? Just updated every day. You can post the code into the same indicator, or you can delete the indicator every day and put in a new one. You can do it for TradingView or Thinkorswim. There was some confusion about what I had said yesterday, so I had to redo it. 8:30, 10, 1 o'clock. That's it. And really, the 1 o'clock, that rig count, look, I worked on those rigs for most of my life. The numbers don't change very frequently. When they do, that's usually scheduled when they're taking a whole fleet offline or putting a new fleet in. Otherwise, if there is a drastic sudden change, it would be a shock, right? There would be something drastically wrong. And I mean, it can happen, you know, it certainly can happen. When they were coming out with those new flex rigs back in 2007 and 2005, they had issues with them. Otherwise, that rig count number shouldn't change all that much. 4 or 5 rigs dropping off or picking up. And so we don't expect any real impact from that one. So by the time we get done with pending home sales by 10 o'clock, and any Fed speakers that we might have that you could spot on finance juice, after that, it should be good to go into the afternoon for things like your 0-day trades, right? I like to do a morning 0-day and then an afternoon 0-day. So you get through the morning and you're pretty much good to go. Yeah, you like that. All right, I know this is a very noisy chart. There's a lot of stuff going on, but when we break it down piece by piece, it really isn't that bad. And we'll eliminate things along the way to kind of get them out of the way. One of the first things I always like to eliminate is the cumulative volume. So what this is doing is looking at the overnight volume starting at midnight, and it's just adding up, or, you know, just keeping track of cumulative overnight volume. And every day at 7:30, I mark it and get an idea what the volume looks like. Well, the indicator marks itself at 7:30, but that's the code that I gave it. After doing this for a couple of years, I kind of got a feel for what a normal morning looks like. There was no book or system or study that I read or learned that said, you know, oh, you need to put this indicator on and keep track of these levels, and it needs to be above this. No, it was just through trial and error every day looking at these numbers until you start to get a feel for it. There's kind of a normal range between, call it 65 and 190. And as long as we're in that normal range, we're good. Obviously, if we're really close to 65, say we're at 70 or 69, it's still pretty low. We want to know what's going on. Why is it so light? And if it's really heavy, if it's near, you know, 180, we'd still want to know what's going on. But above those levels, you see volume in 200, 220, 250 from the overnight. That's big volume. You're going to want to know why. And if it's really light, say down in the 30s or the 50s, you're going to want to know why. It would just call timeout right there and start looking around. Get on the web, try to find some news, figure out why is it so light. On the same side, when we do get a light volume, I always check for that right there. The market maker move shows us if they're hedging in the front end. Remember, hedging is insurance. It's cost. Insurance is not free. Insurance is always a cost. Some call it loss. You call it either one, loss or cost. You don't do it frivolously because it will cost you money. So when we see them hedging in the front end, we know that they're worried about something. They're worried enough to buy insurance for this morning. It's front end insurance. They're not buying it for next week, next month, next year. They're buying it now for today. It's because they're concerned about something. And this isn't my guess. I'm not hypothesizing or giving you some theory or thesis. This is fact. Market maker move happens because the implied volatility within the options chain has rose enough in the front end that it's exceeding the next average out. So when the front implied volatility average is greater than the next one, that is what a market maker move is telling us. Why would it get bid up higher than the other side? Because they're going in there and they're trading. It's the out of the money options that are recorded to even develop this average. That's how it's derived, right? It adds all of these up out of the money on the put side and all of these up out of the money on the call side. And then it averages that number. So it's out of the money trading that gives this its increase. And that tells us that they're hedging. So what do we know this morning? That they're not necessarily sitting out. The volume we had today is about the same as what we had yesterday. They're not sitting out, but they are adding protection. They're a little bit worried about the numbers we're going to get today. Okay, I mean, that's fair. One of the things that I try to work with people on is what kind of trading day are we going to have today? Is it going to be even worth trying to trade? So, you know, when it's options and it's SPY stuck in a $2 range and you don't want to scalp, then there's probably not much for you to do, right? I mean, you know, you're either going to scalp it or you're not. But what people really like to try to get their hands on is days like Friday, right? Y'all remember Friday of last week? Thursday was the start of it. Friday was the continuation of it. Those are the kind of days we want more often than not. So when we're starting the day, we want to kind of get a feel. Is it going to be one of those days? Because I want one of those days. There's a couple of conditions that can increase our chances of getting one of those days. One is, are we outside of yesterday's range? And if we're not, how far away are we from getting outside of that range? Notice that the call wall is still right in our face. So if we're going to try to get a breakout and get through that call wall, it's going to be difficult. It is Friday. We could see them changing the location of this call wall. So we've got to get outside of yesterday's range, which is on its own a significant resistance. It's yesterday's high. But we've also got to get through that call wall, which won't be too bad if they're rolling it out anyways, right? If they're moving it, then there's not really a resistance there for us to fight with. We should be able to get through it. And I'm looking at the ES while we're talking about this, but the difference wouldn't be that much for something like SPY, SPX, QQQ. We got to get through the same thing. Got to get through yesterday's levels. Is there a call wall? How far away is it? Because what is going to get us out of this range that we've been in now for 2 days plus? We're starting into our third day inside this zone. The last time we were in a zone like this, it was 2.5 days, and we came out of it with a vengeance. Really nice expansion. Now the zone is even bigger. Maybe we can stay here a little bit longer, but at some point we are going to leave this range, right? Don't care where you go, just can't stay here. So for easy trade, I love that phrase. No such thing as easy trade. For easy trading, get outside the box. If you are trading inside of yesterday's price action, it could be more difficult. It probably will be more difficult. If you're struggling to be profitable already, you're not yet consistently profitable in trading, quit doing the hard stuff. Do the easy stuff. The easy stuff would be don't trade inside yesterday's trading range. We don't have an MDP. We've already crossed through it multiple times, but we are now a wee bit extended from VWAP. It's interesting that we've had this much of a run at the same time that they're hedging and a little nervous with that much volume. I'm just saying that's a little different. Doesn't normally pan out that way. So when we get into the volume profile here in a few minutes, it'll be interesting to see where we find the bulk of that volume. Was it when they came in and defended this low? Was it right here when we got back into this same cluster, right around that daily pivot point on both sides? Don't know. We'll see in a little bit. We did get very close to the ADR half on the downside. And even though we didn't hit it, we're going to consider that as having been hit only for analysis purpose, right? Because if you've heard me say this before, it'll make sense. If you get to one side of the ADR early enough in the day, it opens the door for you to go to the other side, the other ADR, which for us today would be 49.41. So even though we didn't get there, we got close enough to it that when we finally started to leave the range and we're able to look back now, we can say, yeah, we were close enough to it that now that we've left it, we're probably going to the other side. I don't know that it would have helped you if you were trying to trade at 2 in the morning, but remember the kill zone is between 2 and 4. The kill zone is statistically where you'll see the biggest moves in the market in a 24-hour period within a 2-hour window. I know that's a lot to say all at once, but think of any 2-hour time period in the entire 24-hour trading cycle. Statistically, the biggest move for a 2-hour window is between 2 and 4 a.m. I never trade it. I have, but I never do now. I never go and get my tired butt out of bed at 2 in the morning to trade that thing. It's just not happening. But if you live overseas and that's midday for you, you should be in there just loving it up. 2 to 4 a.m. called the kill zone. I didn't name that, by the way. A lot of these things I didn't name. They just are. 10-day, 30-minute volume profile. We're getting closer to that B shape that I had talked about earlier in this week. And as we lose more of this volume here on the back end, we're going to see this volume profile move. I really thought that it would be up here by yesterday afternoon, maybe today, because all we had to do is sell down into it and get there to bring in just a little more volume. But even if we don't do that, as we lose more of the volume here, this volume that is sticking way out there is going to diminish. And this one that's sticking all the way out here is going to be the new prominent volume location. So the point of control is going to move up there, whether or not price comes back in there or not. That will be our new point of control. The only thing that could stop that at this point would be if price overshoots all of this, comes back down here and starts building more volume along that location, 4811 cog line. I don't think so. Oh, it could happen. Don't get me wrong. Price can do whatever it wants, but I don't see that on the table unless the PCE today is really bad and the market just throws it off and jumps off the building. It's possible. Catch them off sides, you'd be surprised, right? So that is a very shallow area. If we do break through this value area high at 4882, we break through that zone and get below this, we're very likely going to fall to that location really fast. We didn't leave much of a footprint behind. It's a very shallow area. And when it's a very shallow area and we've gone through it quickly once, we're very likely going to come back through it really quickly again. But something defended this low. Now, I've talked about this before, but it always is an odd thing to say. There's markets that are inverse to the S&P, and there's markets that are correlated with the S&P that have their own thing going on. When we were falling back here and price stopped falling, it wasn't because the S&P hit something. The ES didn't hit support. It didn't land on a moving average or something. There was an inverse or a correlated market somewhere else that hit a significant support or a significant resistance, and it quit moving and this quit moving. I know that sounds odd, right? but we've all seen how the S&P can be bullish or bearish based on US dollar Japan yields, the Dixie, what's going on with bonds. So we didn't hit a support level here. Something else did that moves with us or against us, and that's where we turned and went the other direction. So if we were to fall down to this level again, would there still be something here? Well, we made our own support now. So back then we didn't have a support level. And now we do because we made it. The thing is, support is past tense. Resistance is past tense. We look back and say, oh, there was support there. And we look back and say it was resisted there. So this is not yet support. Price has to come down and hit that and show that it was supported. And then we would look back and say, oh, look, that was support. So this is potential support. And keep that word in play, then you're good to go. It's potential support. It is potential resistance. 48.80, 48.75. Get through that, we should dump down to the cog lines. There's a cog line at 48.32. Don't see any reason for that to hold us up. And then 48.11. Otherwise, if we hold that zone, we're going to have the new point of control up there by sometime midday today, or worse, by Monday. So I talked about where the volume was this morning. We can see how they defended along these lows. Got a very large amount of volume here. But the point of control is up here, which is right where the daily pivot point is at. It's what we were looking at on the other chart. And the TPO is right there with us. So that one in blue is not a volume profile. It's a TPO profile, time, price, opportunity. So this is volume by time, and this is volume by price. I know it sounds odd. When we put them side by side, what we want to look for is divergence. Say a whole lot of volume in one spot with a very small amount of volume by time. Say where we run up and break into a new level on the day, like we did over there. If we spent a negligible amount of time and the volume or the TPO would be very minor, while we would be looking for a very large spike on the volume profile, showing we hit an iceberg, or in this case, a ceiling, because it was over our head. But we can find those, we can look for those along peaks and extremes as the day is happening, right? Can't go back now. We got candles in the way. You could use the go back. Thinkorswim's got to go back. You know, you can do it that way, but that doesn't help. So now that we've basically reset everything, think about this for a moment. We came in last night and we dumped down. Now we've turned everything around and we've got it all back again, almost. This is almost like a gap close play, right? So what happens when we get the gap closed? Are we going to maintain this bearish posture and go back down again? Or is this recovery going to continue on beyond this? And that's kind of a big question that needs to be answered. If you think about the delta for a moment, this is delta for the week. I only have enough candles on this chart for Monday. So if I zoom out, you know, it started the week, the delta was at 0, and we've got Monday, Tuesday, Wednesday, Thursday. I don't even have enough days. I'm about to add more. The green lines are the RTH. So this will be Friday's trading session. There was Thursday, Wednesday, Tuesday. So the idea here is we want to look at the profile of the delta profile. Has there been more buying volume than selling volume on the week? And are we above or are we below zero? There we go. Now we got enough days. So we got Monday in there now too. So the green line will demonstrate where Friday RTH starts when we get into this. Otherwise, we're not there yet. We're still in Globex. But look at the zero line on the delta. We're below it. We got below it yesterday, Wednesday, and we haven't been able to dig back out of the hole yet. For the whole week since Wednesday, RTH, we've been below zero on the week. That's more selling a volume than buying a volume. Remember, it's not more buyers than sellers. There's no such thing as more buyers than sellers or sellers than buyers, right? It has to have both parties or there wouldn't be a transaction. But when we look at volume, was it buying volume or was it selling volume? And is there a difference between those two? And if we keep adding it up, where are we at on the day? So this is where we're at on the week. I didn't go in and do just one day. So, if we think about where we've been just for today, if we started here and what have we done since then? We're still looking pretty good, right? On that recovery that I talked about, that U shape. So it's not perfect. I'm just kind of whipping a line across here, but you can see how we're better off than where we were, right? We were underneath it. Now we're above it on the day itself. It's not a zero line, but it'll do. So the point of all this is that U shape price that we're looking at from the overnight where we dumped down and we rallied back up. Did we rally back up with volume behind us? Yeah. And it's looking pretty good. In fact, price isn't back to the top where the dump started, but the delta is back to where we started plus some. So a little positive on that side. I'm still concerned about what happens when we close the gap and what happens if they decide that the gap can't be closed and they just give up and dump it. There's been questions about how to mark the gap. So we're going to do that real quick just to, I'll show you guys a neat little trick. So do this on whatever platform you're on, it won't matter. Thinkorswim, TradingView, Trade-of-8, it doesn't matter. So different brokers mark the close at different ways. And there's different close. There's 4 o'clock close, 4:15, 5 o'clock. Which close is close and which one are you supposed to use? And how do you make it to where you can see the right candle to close it on? Just go to your daily chart. This works on all platforms as long as you have a drawing tool and you can go to the daily. Go to the daily chart, and now you'll see what the broker considered close for whatever instrument it is that you're looking on. 49.19, that was the close of yesterday because I'm on a daily chart, and that is the close of that daily candle. I can't get this wrong because that's what the broker considered close. Now, if I go to another broker, it might not match, right? Another broker might have a different close, even for the same product. Don't get hung up on that, right? Our job isn't to compare different charting platforms and argue about who is right about yesterday's high and was it one tick higher or lower. It doesn't matter. And even for the close, if your broker says it was 49.20 and mine says 49.19, don't stress on it. It doesn't matter, right? If you're consistently using your broker every day, then do that. Don't worry about trying to compare your broker to somebody else's. Volume is delayed by up to 30 seconds. That's how long the broker has to tell you that a transaction happened. So even level 2 and time and sales has a 30-second window of delay that they can literally wait 29 seconds before they show you that a trade happened. If you didn't know that, welcome to welcome to that little bit of information. The point of that is that brokers can wait 15 seconds while a different broker could wait 20 seconds. And so you might see volume on one trade faster than another on one broker versus another. but everybody is delayed. Everybody has that delay, right? So it's not like your broker sucks and you're the only one. All right, so everything has been range bound, not just the S&P and the NASDAQ, the US dollar, Japan, the Dixie, the 10-year, everything's range bound. So this compression is across the board and starts to stack up. What's going to pop first and how big is it going to be? Will that pop come due to economic input, or is it going to come from the market just finally getting tired of waiting? That's what happened last Friday, right? Remember when we were talking last Friday, the market, and I said it's going to get tired of this wishy-washy kind of sort of maybe, and it's going to make a decision one way or the other. And oh boy, it made that decision, right? Because we were still down here in that kind of maybe sort of state, and the market just got tired of waiting like that. So we had that big breakout day. Well, we haven't been up here for too long, right? But we are working on day 3, and this is IX10. The range is getting smaller and smaller. So not only are we in a range, but the range is compressing. Nothing in nature likes compression. And if you don't let off a little bit of steam, it'll explode. Even just damming up water, you have to let some water out along the way. So the pressure is on here and it's getting tighter and tighter. And this is going to leave this range. It will. It cannot stay here forever. So we know it's a fact it's going to leave. There's no reason to try to guess or assume which direction it's going to go. We don't have to guess or assume. All we have to do is prepare for the move and take it. Now you can try to get ahead of all of that and you can pick a side. If you think we're going to break out to the upside, you can try to get in as close to the low as possible. If you think we're going to go to the downside, you can try to get in across the highs as high as possible. Or if you don't have an opinion yet, all you got to do is wait for the breakout and trade it. 4911 is a cog line. It's COG, center of gravity, and it's the 50% mark. It's right in the middle. Look at these wicks along the lows. The buyers have stood up at that 4,900 and defended that low. So this seems to be a buy zone all the way up until the day that it isn't, right? Because that'll be how that goes. But just like the old phrase, it's support until it isn't. Well, that's a buy zone until it isn't. But as long as we can still see they are defending that level, as long as it shows up on the dome, it's in level 2, we can see the active trades adjusting, stacking, and pulling along those levels, then they're down there ready to defend it. The problem is, across the high, they've also demonstrated a willingness to sell up there. So are the sellers done? Is there still liquidity up here, and can we get through it or not? It's kind of the line in the sand, right? So you can see where we're getting right back up into that same zone. We are literally right there. And here on the left side, we can see those 2 days. So we got above that call wall, 49.28. And we extended just a little bit more into that 49.32 cog line, and then down we went. So 49.28 is the call wall we have to get through. And then 49.32 is the center of gravity that we have to get through. what you're going to want to be watching for is for these options to be moved. So you can watch that right through the options changes, see if they're up there adjusting. Look at time and sales and options to kind of catch that movement. Otherwise, you need an options platform, like Spot Gamma, Traditix, Mentor Q, something that you can bring up the ES futures on and see the options for it. Keep in mind, the market doesn't owe us anything today. A big blowout move, big expansion, one side or the other. All we have to do is go into the end of the week with this expansion that we've done for the week. That looks really good when you bring it out on the weekly chart and you look at it. We're still very bullish. We have that posture. And if we go into the close this week looking like this, the market will love it. All right. They'll be able to talk about it, the bobbing heads on TV, stay above 49.02, and we keep the 50% mark of this weekly bar. And that's a bullish continuation into next week. So all we have to do, and that's not much, right? Just keep it. We're 3.65% above the 10-week. So we're still not overbought. It doesn't owe us a pullback. We haven't traveled too far, too fast. And we have the weekly expected move right over our head. We've hit it twice this week, or at least we came really close to hitting it that second time. 49.27. Remember that we close inside this range 80% of the time on the S&P, 70% of the time on everything else. So while it's not guaranteed that we're going to close inside this on Friday by 4:15, we do that 8 out of 10 weeks. While we're here and it's on Friday, we can measure this week's range to next week's range. The problem with that is that this next week's range, while we can see it today, it's Friday, it's not set in stone until tonight after 4:15. So we can look at it now, but just keep in mind, it's not done yet. After 4:15 tonight, you can go in and do what I just did, and you can compare it again. We'll look at it on Monday either way. But so far, looking at it right now, I would say that next week's range is just barely, just slightly more than the current week's range. Now, these ranges are built based on math from volatility. So when volatility is bigger, the range for the week is bigger. And when volatility is lower or less, the range is less. So one of the glances that we can get from this is next week has more volatility in it than this week. Well, that makes sense because we got FOMC next week. We got QRA next week. So we got some really big deal. But the market didn't really price in too much more. That was a negligible amount so far. We want to keep our eye on that today and see if it gets bigger or heavier, gets greater. We're 1% above the 10-day moving average. It's still on the decline. We're still fading back towards that 10. It's not like back here when we were driving away from the 10. So we're still fading down towards that 10. That can keep us range bound and choppy. We can see, when we were fading through all these areas, we're just sitting in a sideways market. Same thing through here. We had a little bit of a bump up, but mostly we're just sitting sideways in that market. So we could, like I had mentioned, just chop at this level. The market's already made a good move for the week. It just has to keep it, which is what it looks like it's been trying to do. But I wouldn't expect much more. If we get through that call wall, really start looking to see if they've rolled it. Because if they have, then we can. And we can get up to the full ADR, 49.63. In fact, we can get there, and then we can get the market maker move too. which would be another 19 points. Call it 20 just for some easy math. That'd be 49.83. We could do that today easily. That's not even reaching far. We have a voodoo line up there. The white one is a really big deal. We're not going to get past that. Not today. And I'm going to leave you with this. This is where the weekly pivot point is, way down here. That's your weekly pivot, 48.32 cog line. And we're very close to 49.32. We're close. It's almost 100 points away from the weekly pivot point. I don't have a gauge on how far away from the weekly pivot we get, not like when I measure the 10, but statistically, on average, this is as far away as you're going to get unless we get something very strong, very drastic or extreme that can not only break through that call wall, break through the ADR half, and propel us even higher than that, and getting through Wednesday's high, so this week's high, all those resistance levels, and drive farther away from the weekly pivot point at the same time, expanding more than 100 points away from it. It would have to be some monster news to do that. So it's possible. I never want to say a market can't, but it's going to have to be something really good. Otherwise, what we have for the day, China ADRs are down, semiconductors are down. And for what's up? What's up? Bitcoin, gold, healthcare. Not even healthcare. Not enough. Stops at gold, Bitcoin, and gold. Those are the only two things that are up. So everything else is sideways, waiting on data. And that's why I'll leave you here and see you.